All right, welcome to The Explainer. Have you ever wondered how a single ship way out at sea can actually affect the price you pay at the pump and, really, the stability of the entire global economy? Well, today we're going to trace those invisible threads because it all starts with just one incident. And this quote, it really nails the core idea. Our global economy is so tightly wound, so interconnected, that one event in one part of the world can set off a financial chain reaction that hits all of us. And it can happen incredibly fast. So to really see how this all plays out, let's zoom in on a real-world flashpoint, the tense and absolutely vital shipping lanes of the Persian Gulf. You know, when you hear about attacks on oil tankers, it's easy to think of it as just a regional problem, right? But it's way bigger than that. It's a direct threat to the world's energy supply. And believe me, the entire market is holding its breath. And here's the thing you've got to remember about markets. They run on fear and expectation. So even just the possibility of less oil in the future is enough to make prices jump today. It's all about pricing in that risk. Okay, so why all the fuss about this one particular spot on the map? What makes trouble here have such a massive, outsized impact? Well, it all comes down to geography. We're talking about a single, super narrow channel of water. It's basically a choke point for the entire world's energy supply. I mean, just let this number sink in for a second. 1/5. 1 out of every 5 barrels of oil consumed on the entire planet, every single day, passes right through this one tiny corridor. So you can imagine, right? Any threat, any kind of blockage, even for a short time, it could literally pull millions of barrels of oil off the market overnight. The potential for chaos, it's huge. Okay, so let's follow the money. What's the first thing that happens when this choke point is threatened? Well, the first shockwave slams right into the people who have to navigate it, the shippers. So if you're a shipping company, you're suddenly in a really tough spot. The risk of attack goes up, so your insurance costs, they go through the roof. So you think, okay, maybe we'll just take the long way around. But that means more time, more fuel, more money. Either way you slice it, the cost of moving that oil just jumped. A lot. And it's not just the shipping companies feeling the pain. Even the big players, the major oil producers like Saudi Arabia, they have to scramble. They're forced to make these huge, really expensive logistical changes, like using pipelines to send oil all the way across the desert to the Red Sea, just to get around that risky strait. And here's the bottom line. All these extra costs, the insurance, the longer routes, the new pipelines, they don't just disappear. Nope, they get baked right into the final price of oil. And guess who ends up paying for it? We do, every time we fill up our cars. But, you know, higher gas prices, that's just the first domino. The story doesn't end there. Not even close. Let's trace how this single price shock starts a much bigger financial chain reaction. So it all kicks off with the price of oil going up, right? That's the energy that powers pretty much everything. And, of course, that immediately hits transportation costs. Everything from planes to trucks to cargo ships, it all costs more to run. Which then means it costs more to make things and to grow our food. Suddenly, the price of everything on the shelves, from your phone to your groceries, starts creeping up. And boom, that's it. That's how a problem in one little shipping lane balloons into a much bigger, economy-wide problem: inflation. So what happens when inflation starts to heat up? Well, the world's financial watchdogs, like the U.S. Federal Reserve, they have to step in. They can't just let it run wild. And their main weapon against inflation? Raising interest rates. In the U.S., this has a really powerful side effect. It makes the U.S. dollar stronger, turning it into what investors call a safe haven when things get chaotic everywhere else. Okay, now this is where things get really interesting, especially when we talk about gold. This stronger dollar creates this weird paradox. See, on one hand, gold is priced in US dollars, so when the dollar gets stronger, gold gets more expensive for everyone else in the world. It actually might hurt demand. But on the other hand, if you're in a country where your own currency is tanking, that same expensive gold suddenly looks like the only safe place to park your money to protect your savings. It's the same asset viewed in two completely opposite ways at the exact same time. It all just depends on where you're standing. So we've followed this ripple effect all the way from a tanker at sea to the global financial system. So what's the big picture takeaway here? It's pretty simple, really. Energy is, once again, a massive geopolitical weapon. Any country that can control these crucial energy pathways has a huge amount of leverage over the entire global economy. Now, don't get me wrong, governments aren't totally helpless. They have tools, like releasing oil from their strategic petroleum reserves, to try and calm the markets. But, and this is a big but, those are just temporary fixes. They're like putting a Band-Aid on a gaping wound. They can't solve a serious long-term supply disruption. And that leaves us with one final, really important question to think about. The answer connects all this high-level global strategy right back to our everyday lives, to the price of fuel and the cost of our food, reminding us that in this deeply interconnected world, a crisis at sea, well, it really is a crisis for all of us.